By the time most people first heard the term AI trading, the technology had already been quietly shaping markets for years, not in dramatic headlines, but in invisible whispers, micro-decisions executed in milliseconds, small price movements amplified by neural networks, and portfolios subtly optimized by models most investors never saw. Today, a new wave is spreading. Retail investors using AI to guide their money. What began as experimental algorithms used by hedge funds is now packaged into smartphone apps, glowing dashboards, and friendly digital advisors. The promise is seductive: unbiased logic, perfect timing, and investing without the fear or greed that defines human behavior. But the story is far more complex than a simple handoff to machines. In this video, we'll explore how AI-powered investing emerged from early algorithmic trading, what the latest generation of AI investing apps and autonomous trading agents can actually do, and the surprising risks hidden beneath their polished interfaces. We'll trace the evolution from Wall Street quant rooms to ordinary smartphones, examine how these systems make decisions, and look at what leading financial analysts are saying about a future in which software trades faster than humans can think. And by the end, the question will become unavoidable. If AI is shaping markets, who is really investing? Let's begin with the roots. Algorithmic trading isn't new. Large financial institutions have used automated strategies since at least the 1980s. Firms like Renaissance Technologies and Citadel studied patterns buried in stock data, correlations too subtle or too volatile for human reasoning. Their systems didn't understand companies in a human sense. They simply detected statistical relationships, then traded on them. Fast forward to the 2010s, and machine learning reshaped these tools. Suddenly, models could adapt. They learned from data, refined strategies, and at times even anticipated broader market movements. Deep learning allowed systems to ingest mountains of information: price history, volatility cycles, earnings reports, even sentiment across financial news. Still, this technology belonged mostly to the financial elite. The average investor could only watch from a distance. But here's where the picture becomes clearer. Around the mid-2020s, the same breakthroughs that revolutionized language models began spilling into finance. The capabilities used to write essays, diagnose code, or craft business plans were now being redirected toward investing. The first major shift was AI-assisted research, applications able to scan thousands of company filings, quarterly reports, or Federal Reserve notes, distill the key takeaways, and highlight potential risks. Channels like Cold Fusion, Economics Explained, and Bloomberg Technology began reporting on consumer-facing AI investment advisors that promised to democratize insight once available only to analysts with 6 screens and a Bloomberg terminal. Then came portfolio optimization. Instead of static retirement risk questionnaires, models could analyze spending patterns, global indicators, and evolving risk tolerance. They could propose diversified allocations based on economic stress tests, simulate recessions, or reallocate funds when certain thresholds were breached. But even that was just the beginning. A subtle but profound transition soon followed. AI agents capable not only of analysis, but of autonomous trading. These systems don't just recommend moves, they execute them. Some mirror ETF strategies. Others follow factor-based logic like value, growth, or momentum. More advanced versions apply reinforcement learning, adjusting trades based on trial and feedback, not unlike how AI learns to play games like Go. And in the background, they continuously monitor everything: price swings, inflation indicators, currency strength, bond pressure, geopolitical headlines, and commodity shifts. To many, it feels like investing with a superhuman partner. Yet, there's a deeper layer. Most users see a clean interface, projected returns, AI-generated summaries, maybe even a confidence score beside a stock's name. But underneath is a machine trained on the past. Every model, no matter how impressive, is anchored in data that has already occurred. And markets are not static systems. They are living organisms shaped by irrational optimism, sudden fear, and unpredictable events. Financial historians remind us that before every downturn, models believed the future mirrored the recent past. Before the 2008 crisis, mortgage-backed instruments were considered safe because historical default rates were low. Before the dot-com collapse, many believed the Internet's exponential growth would never slow. Models embedded those assumptions right until they cracked. This is why seasoned analysts caution that AI confidence can be mistaken for certainty. Let's pause and examine how these agents work at a fundamental level. First, they ingest data, price histories, macroeconomic indicators, and sector performance. Some expand further, analyzing volatility signals, liquidity flows, spreads between bonds and equities, or even technical formations like moving averages. The model searches for patterns. If a combination of variables historically produced positive returns, the system learns. If certain conditions signaled higher risk, it flags them. This process resembles digital intuition, a probability-based model of how the market is likely to behave. Many use what are known as factor models, identifying whether companies are undervalued relative to earnings, whether they show momentum, whether their balance sheets reflect resilience. Others build neural portfolios that test millions of tiny scenarios, hunting for stability. Some apps have gone further, generating investment theses in plain language. They might produce rationale such as, historically, companies with strong free cash flow and declining debt outperform during tightening monetary policy. The model's outlook indicates increased resilience within this category. It feels eerily close to analyst-level reasoning. But there's also the moral seduction of automation. It removes emotion. No panic selling on red days. No euphoric buying when markets surge. Decisions become neutral lines on graphs, not reactions from a tired investor at 2 a.m. This is precisely why many personal finance channels warn that the technology could be disproportionately powerful in the hands of institutions that deploy it at scale. A hedge fund with thousands of automated agents can move liquidity much faster than community investors using small retail apps. Yet the democratization angle matters too. AI investing apps give newcomers access to concepts once reserved for CFA-certified analysts. Sharp ratios, risk-adjusted performance, sector correlation modeling. Instead of hunting through PDFs, AI agents summarize long earnings transcripts, benchmark CEO's tone shifts, and highlight legal red flags hidden in the footnotes. There is extraordinary educational value here. Still, the risk shadows remain. These systems are only as robust as their training corpus. They might overweight recent market cycles, assume stability that no longer exists, or fail to recognize new regulatory shocks. Some models could unintentionally herd investors into the same trades, producing amplified swings as algorithms chase similar signals. Regulators have begun to ask the same questions. If a machine triggers a cascade, who is responsible? How do we audit decision paths inside neural models that cannot easily explain themselves? The answers aren't simple. Even more nuanced is the philosophical shift. For centuries, investing rested on human judgment, intuition, research, long coffee-stained nights studying balance sheets. Now, decisions can be compressed into seconds by agents that never sleep and never doubt. Some fear it disconnects humans from financial literacy, outsourcing understanding to a machine. Others argue the opposite, that AI brings transparency, education, and discipline to a field long dominated by emotional mistakes. And the truth may be somewhere in between. Because here's the quiet reality. AI doesn't remove uncertainty from markets. It simply reframes it. It gives us prediction, not prophecy, insight, not inevitability. And whether we welcome that or mistrust it will shape how this technology integrates into our financial habits. In the end, AI investment tools reveal a profound truth. Markets are a mirror of human complexity, and even the most advanced model cannot rewrite that. AI can accelerate research, reduce bias, and bring professional-grade strategy to ordinary people. It can expose oversights, reveal patterns that hide in noise, and encourage slow, rational decision-making in a world of short-term impulses. but it cannot guarantee outcomes. It cannot eliminate risk, and it does not possess foresight beyond the limits of data. The rise of trading agents and AI-guided portfolio engines marks just another chapter in the long story of finance. A story where each innovation promises clarity, only to uncover new questions. Perhaps the real lesson is this: AI investing isn't the replacement of human judgment, but an extension of it. A tool that amplifies potential while reminding us that money will always live at the edge of uncertainty. The wisest investors may be those who blend machine logic with human perspective. Steady discipline informed by technology, but grounded in humility. If you enjoyed this calm exploration of AI investing tools and autonomous trading agents, feel free to subscribe for more stories about finance, technology, and the systems quietly shaping our world. Thanks for watching, and until next time, stay curious.